Hey friends, tax season is coming. I've got you covered with a 12-episode Saturday series running January through April. Each week, I'll share tips to help small business owners avoid tax season stress, get clarity, and lighten the load by delegating what you don't need to carry. Tune in every Saturday and step into tax season with confidence. I am going to tell you about a real client who came to me for bookkeeping help. One of the first things I did was to go through 6 months of credit card and bank statements line by line, verifying every single charge. In those 6 months, I found $2,847 in duplicate charges, errors in billing, and subscription fees for services she had canceled months earlier. Almost $3,000 in 6 months. But here's the tax problem that made this even worse. She already had deducted all those expenses on her quarterly estimated tax calculations. She based her tax payments on profit figures that included those $2,847 in expenses that didn't actually incur. When we corrected everything, her actual profit was higher, meaning she underpaid her quarterly taxes, and now she faced penalties. This is the double-edged sword of messy transactions tracking. You lose money by errors when you charge things accidentally, and you create tax compliance problems by deducting expenses that don't hold up under scrutiny. Today, we're talking about the expensive mistakes hiding in your transactions and why catching them matters for both profit and tax compliance. I'm Patricia Oholeguy, and this is Tax Season Saturday. Let me tell you what I found in Jennifer's statements and why it mattered for taxes. She had duplicate charges. Her project management software charged her twice in 1 month, on the 3rd and on the 17th. Both charges showed the same vendor, same amount. Nobody caught it. This happened 4 times over 6 months that I reviewed. Total cost of $196. But there's the tax problem. She deducted all 8 charges, $392 total, as a business expense. She only actually paid $196. If audited, she'll have to pay back taxes on the $196 in phantom deductions plus penalties and interest. Yes, that's right, $196 in ghost deductions. Then she had subscriptions that creeped with tax consequences. She had a graphic design software subscription for $29 a month that she had canceled in February. It was still charging through her until August, 6 months later. $29.99, that's $179 with 94 cents lost. But the tax issue is worse. She wasn't using the software anymore. It provided no business benefit after February. Technically, those charges from March through August aren't legitimate business expenses because they served no business purpose. Do you catch what I'm saying? So if the IRS questioned it during an audit, they could argue that those deductions should be disallowed because the subscriptions wasn't actually being used for business. The social media tool disaster is another area where I saw that she was losing money. A $79 monthly charge that she did a free trial, and then she forgot about it and never used it again. But it was billing for 8 months, and that totaled $632. That's a tax problem. Same issue. She was deducting $632 annually for a tool that provided 0 business value. No business purpose equals questionable deductions equals an audit risk. The IRS wants to see that expenses are ordinary and necessary for your business. A subscription that you never used fails that test 100%. A vendor billing error, such as a website hosting, should have been $25 a month, but was billing $39 a month for 11 months. So that was $154 in overcharges. Tax problem? Sure enough, she was deducting $39 a month when the legitimate business expense was only $25. The extra $14 a month, which is really $150, $154 annually, was an error, not a legitimate expense. If questioned, she'll need to correct her deductions and potentially pay back taxes on the difference. These aren't isolated incidents. These are patterns I see constantly, and each creates both profit loss and tax compliance risks. The first pattern, duplicate charges, creating phantom deductions. When payment systems glitch and charges you twice, most business owners deduct both charges. They see two $100 charges from the same vendor, they categorize both as a business expense, and they move on deducting both of them. But you only paid for it once. You only received one business benefit. The second pattern is subscription renewals that you're not using. This is a rampant and creates significant tax problems. You cancel a service in March, but it keeps billing through December. You're deducting 10 months of charges, which is about $300, for a service that provided zero business benefit for those 10 months. The third pattern I see is personal charges mixed with business. Billing mistakes sometimes include charges that were actually personal and not business. Maybe they charge your business card for something you bought personally by accident, or they mixed up accounts. If you're automatically categorizing and deductions everything from certain vendors without reviewing each charge individually, your deductions personal expenses as business expenses, and that, my friends, if you deduct personal into your business, that is considered fraud. So during our Monday night clarity compass session, we specifically review transactions not just for accuracy. We ask, is this deductible? Is this the right category? Is this 100% business or partially personal? So here's how you can protect yourself and make sure that you are accounting for every transaction accurately. Step 1, do a weekly transaction review and make sure that you have all categorizations correctly marked. Every Monday, review every transaction from the previous week. For each transaction, ask specific questions. Is this charge legitimate and accurate? Is this fully deductible or partially deductible, or is it not deductible? Do I have documentation to support this deduction, or is this categorized correctly for tax purposes? The second step is to flag and investigate anything that looks questionable before you deduct it. If someone seems even slightly off, or appears wrong, or is an unexpected timing, or looks like a duplicate vendor, or a questionable business purpose, flag it immediately. Don't just categorize it and claim it as a deduction. Investigate first, deduct after you confirm that it's legitimate. We teach members to use flagging in the systems of QuickBooks, and anything questionable gets marked. The third step is how to dispute charges immediately and adjust your books. When you discover a duplicate charge or billing error, dispute it the same day, but also adjust your bookkeeping immediately. If you already deducted that expense in your quarterly tax calculation, you need to account for that refund properly. If the refund comes in the same tax year as the original charge, you can typically reduce the expense category by the refunded amount. Now, the step 4. Document everything for audit protection. When you find errors, document what happened, keep records showing the original incorrect charge, the dispute filed with the vendor, and the refund received, and bookkeeping adjustments made. So now here's the overstated expense problem. If you deducted $5,000 in expenses throughout the year that included $800 in duplicates or canceled subscriptions, that means you're underpaid quarterly estimated taxes. If your statements show charges you disputed and got refunded, but your bookkeeping doesn't reflect that adjustment, the IRS is seeing the discrepancy. If you're deducting $4,000 annually in software subscriptions, and if you cannot actually demonstrate that you're using those for business purposes, expect deductions to be disallowed. I forgot I canceled it, or I meant to use it, but I never does not go under a deduction. The prevention strategy is a weekly transaction review to prevent year-end tax disasters. When you catch and correct errors every month throughout the year, your books look accurate and reflect reality when December 31st arrives. So now think about it. 3 charges, same day, same vendor. That's your red flag to investigate instead of automatically categorizing and deducting the transactions. Your profit is being drained by billing errors you're not catching. Worse, you're creating tax compliance problems by deducting expenses you didn't actually incur. The solution isn't complicated. Systematic weekly transactions reviews with proper flagging and investigations before claiming deductions will help you make sure that you are ready for an audit. Every Monday night at 7 p.m., we do this together in the Clarity Compass Method membership. We review transactions for accuracy and we make sure that you are falling on the right categories. Or you can hand the entire process to our white glove service team and we handle all transactions reviews. If you have questions, make sure to visit theclaritycompassllc.com so that way you can start catching errors this Monday before they become tax problems next April. Stop trusting without verifying. Start reviewing systematically for both profit and protection. And again, I want to thank you all for tuning in into Tax Season Saturdays, and I'll see you all next week for the last episode of Tax Season Saturdays. Bye.
Hey, thanks for joining this Saturday's tax season special. Don't forget, you can join the Clarity Compass membership for weekly support or reach out for our white glove bookkeeping services. And remember, we're not lawyers or accountants, just your guide to clarity. Catch the next Saturday episode in this special tax season series. See you then.